We actually raised our target this morning. We went from 432 to 436.
And so I think there's a lot of room for people to buy it and buy it on this dip ahead of a very good quarter. They did a massive amount. So to put in perspective, about 5 coal plants they did during the quarter, if you put that in terms of batteries.
In this video, a top 0.1% stock analyst says Tesla stock will more than double over the next year. You know what else will more than double over the next year? The number of exclusive videos I've posted to Patreon, which now stands at over 180 and counting. Very fast. If you're not already a member, you know what to do. Click the card in the corner or the link in the pinned comment to join, and I'll see you over there. I'm a big fan of accountability and credibility, so before we hear from Colin Rush, let's see what his track record looks like on not only Tesla stock, but stonks in general. So, the guy that says Tesla stock will more than double over the next 12 months, per his tipranks.com profile, a 5-star analyst, in fact, ranked number 4. Yes, number 4. Out of 7,987 analysts, and number 10 out of 22,588 experts. Doesn't get much better than that. Now, if you guys are long-term viewers of the channel, you'll remember this exercise from a year ago. And a year ago, same shit. Maybe it was number 6 or 7, I don't know. The point is, Colin Rush is consistently on the money, consistently right, and consistently bullish on Tesla. Isn't that interesting? Now, the thing that does my fucking head in about this guy, and I really do mean does my fucking head in, is how many different stocks he's covering, yet still managing to get right. This year alone, recommendations on about 20 individual stocks. Success rate over the last 12 months, 56%. More importantly though, average return, 53.2%. Does not get much better than this. If we just drill down to Colin's recommendations on Tesla stock, back in 2017, a few hold ratings with Tesla around $20 a share, then recommending investors buy Tesla stock around $22, $23 per share in mid to late 2018, another buy rating later in 2018, another one in 2019, and another one in 2020, and another one in 2021. So for close to the last half decade, Colin Rush has been recommending investors exclusively buy Tesla stock, a recommendation that has aged relatively well. In my uninformed opinion, there are approximately 2, maybe 2.5 analysts covering Tesla stock on Wall Street who actually know anything close to what the company's really doing, what they're really about, and what their future really looks like. Colin is top of the pile. The guy just gets it. Now, I did some digging today because I'm trying to figure out how the fuck does this guy understand Tesla when just about everyone else, all of his colleagues in the same industry, all of his peers are completely clueless clowns. So I did some digging. There's got to be something different about this guy. He's not a typical Wall Street wanker. He gets it. He doesn't live in the same bubble. He's not stuck in cell D39 of his spreadsheet. What makes this guy different? Well, I found out. This is Colin Rush, dancing. And yes, this really is Colin Rush, and I really did do some homework, and I really did figure out why this guy gets Tesla when just about everyone else on Wall Street is clueless. In a past life, and I'm not kidding, this is real, Colin was a choreographer. Turns out, there's a lot of overlap in what he used to do and what he now does. He's an outsider. Didn't join the Wall Street world until he was 30 years old. Colin Rush, a former choreographer, demonstrates how the artist's skills of listening, sensing, and predicting outcomes transfer directly into his second career as a Wall Street analyst. This stuff actually really matters. Like I said, most Wall Street analysts are clueless when it comes to Tesla. The few that understand Tesla, I'm trying to figure out what separates them. How do they see what their colleagues and peers do not? Well, it turns out in Colin's case, the answer's quite simple. He's an outsider. The guy wasn't dreaming about getting an internship at Goldman Sachs from age 5. I personally believe this gives him a huge advantage over his colleagues because he hasn't built an intellectual prison for himself. Oh, that's how you look at this thing. That's how you think about this because that's the way that Wall Street does it. I personally believe that outsiders have the biggest advantage when it comes to understanding an opportunity like Tesla. Because rather than reasoning by analogy and working on a bunch of assumptions that everybody knows are true, somebody with a slightly different perspective can look at things objectively and comprehensively rather than making some colossal errors of judgment like, oh, I don't know, here's a good one, thinking Tesla's a car company and not thinking any more than that and then deciding, oh, well, I need to compare the valuation to a car company. It doesn't make sense. Don't buy Tesla stock. Anyway, long rant. Point is, Colin gets it. Maybe now we know why. Let's see what he's got to say. Pay very close attention.
We actually raised our target this morning. We went from 432 to 436.
If you suck at math, that would suggest Tesla stock more than doubling over the next 12 months. Of course, Colin isn't credible. It's not like he's a top 0.1% analyst with a great track record, so you should ignore everything he says about Tesla stock because he's obviously wrong.
There's a couple things that we're looking at. One, there's an awful lot of operating leverage left to be had in this model, and it's coming from efficiency in the R&D spend as well as the SG&A. As they scale up revenue here, we're expecting them to be able to get some leverage off that operating side.
This is one of the most important points about Tesla that practically everyone is ignoring or just doesn't understand in the first place. Let me show you guys a graphic that sums this up perfectly. This was originally posted by ForwardCap on Twitter. A picture is worth 1,000 words. A chart like this is worth potentially trillions of dollars of future revenues and billions of dollars of profits. What we're looking at here is Tesla's revenue versus Tesla's operating expenses, which include SG&A and R&D. Let me explain what's going on here if you're not a nerd. Back in 2017, Tesla did revenue of less than $12 billion and had operating expenses of around $4 billion. The ratio there, about 1 to 4. Tesla's operating expenses, about 25% of their total revenues. However, over time, we've seen a gigantic separation. In 2022, Tesla's operating expenses, this is an annualized rate based on Q3 2022, just for the record, come in at less than double what they were back in 2017. Yet, Tesla's revenue now has gone from about 12 billion to almost 100 billion. This is operating leverage in a nutshell. Typically, what you'll find generally as a company scales up, there'll be a fairly close relationship between total revenue and operating expenses. In other words, if Tesla was a normal company, maintaining a similar ratio between revenue and operating expenses, Tesla's 2022 operating expenses should be close to $20 billion, not less than 7. I want to make sure everyone understands. This, what we're looking at on screen now, is not normal. Tesla is a money printing machine. They are so incredibly lean and resourceful, it defies belief. Many of the Tesla Q dolts at this point in time are literally asking Tesla, did you guys commit fraud or make a mistake? It's not possible that your operating expenses are so low. It doesn't make sense. They do make sense. It's just nobody else has ever done this in the history of large companies, ever. It's almost as if Tesla is superior to any other company that's ever existed, ever. At least based on this metric. Here's everybody's favorite, Gordon Johnson, scratching his head. Hey, Elon Musk, this seems impossible. Can you explain this? How is this possible in reality? Are these gap numbers? Thanks. Gordon, of course, highlighting on the bottom line here, Tesla's SG&A increase just 8.2% despite a 146% increase in cars delivered, blah, blah, blah. Check this out. An 8% increase over 2 years despite inflation? Really? The guy literally cannot believe what he's seeing. Just can't accept the numbers, the actual numbers. And I do understand, like I said, no other company has ever done this at this scale, which obviously means you should not own Tesla stock because it's a trash company, right? And here's the kicker. This trend will continue. The separation between Tesla's operating expenses and total revenue will continue to grow as they scale up, meaning their profits will continue to increase.
But more importantly, it's really on the cost side from a manufacturing perspective. They're still underutilized in both Austin and Berlin, and they're just beginning to see the impact of the 4680 batteries start to flow through. And we're expecting, some significant upside on the gross margins on the order of, potentially 4 to 7% of incremental gross margin as we go through the next couple of years.
That's interesting. What about demand? How do you answer concerns about either softening demand in aggregate or at least more difficult share environment as new competitors come on board?
Yeah, that's the heart of the matter here with the stock right now. So we're seeing some pretty good products coming out of Mercedes and BMW here. We've seen VW and Hyundai be real leaders in terms of the EV space and trying to work into the lower cost models. But what we're seeing from Tesla is just ongoing evolution of the manufacturing platform and really driving cost out in a couple of levels. One with the stamping program, second with the structural battery pack.
How to determine whether or not an analyst covering Tesla knows anything at all about the company and should be taken seriously or not. They talk about operating leverage, and they also talk about the evolution of Tesla's manufacturing systems and specifically call out the gigacasting and the structural battery pack. This is someone who gets it. These are two of the most fundamental pieces of the Tesla puzzle. Something just about everyone is completely missing.
And then the evolution of just the efficiency of the powertrain. I think one of the things that we're really intrigued by is their insistence on sticking with the 400 volt architecture, as a lot of other folks go to 800 volts to get better range and try to simplify some of the design. And we think Tesla's going after the low cost, high volume components that's going to help them drive cost out. And so as we look at some of these other products coming to market, we think that the actual hardware of the vehicle actually for Tesla is going to go, it's going to have a lower cost structure structurally.
Just want to quickly translate that comment. Sometimes when your brain's as big as Colin's, you forget that most people won't really grasp what you're saying. When Colin's talking about Tesla, the vehicle platform having a lower cost structure, what this translates to is good fucking luck competing with Tesla on cost. You're doomed. Let me explain. Colin's accurately describing Tesla's extreme cost advantage when it comes to producing compelling electric vehicles. No other company on the planet can produce an equivalent electric vehicle for close to the same cost as Tesla. Why? No gigacasting, no structural battery pack, no octavalve heat pump, none of the innovations that Tesla has done in terms of manufacturing vehicles at scale, none of them. And Tesla isn't done. They continue to drive their costs down. So the point, if you read between the lines here, let's just use some hypothetical numbers. If it costs Tesla $35,000 to produce, say, a Model Y, again, just pulling these numbers out of my ass, and you're a competing company, and for you to even make a similar vehicle with similar range, similar performance, similar safety, similar features and functionality, it costs you $50,000, you cannot compete with Tesla unless you're willing to go bankrupt by doing so. And what I mean by that is selling your vehicles for no profit or worse, at a loss, just to compete on price. This is a real big fucking problem for other companies. In fact, it's an existential threat to other companies. No matter what you do, if you're attempting to compete with Tesla, you're not at the same scale. You haven't implemented the same innovations in terms of manufacturing, and it's costing you $10,000, $15,000 more to make an equivalent vehicle. You're unequivocally f***ed. You either need to sell them for significantly higher, and how do you get people to buy something that's worse for more money? Well, you brainwash them with advertising. It worked on some people, but not most. So that's not a sustainable long-term strategy. Or alternatively, you actually sell the vehicles at a loss, compete on price. Tesla's making a huge 30% margin, and you're selling a vehicle for the same price and losing money. Next minute you go bankrupt. People really aren't getting this. When you hear people, oh, the competition is coming, you can be absolutely certain, unequivocally, that the person making this claim is an absolute moron who doesn't know what they're talking about, and therefore should have prefaced by saying, I'm a moron and I don't know what I'm talking about, but the competition is coming. No other company has this kind of operating leverage in the automotive industry, not even close. The more Tesla scales, the more profitable they become, not just in absolute terms, but in relative terms, because of the operating leverage. And in addition, in order for the competition to come anywhere other than all over themselves, these companies would somehow need to implement the same manufacturing innovations and gain the same cost advantage as Tesla. The problem is, and I don't mean to say this too insultingly, but they don't have the talent. They're just not going to be capable of doing this. All the best engineers are already working for Elon at Tesla or SpaceX. You can't expect a bunch of B, C, and D players, a bunch of leftovers, to do new cutting-edge material science, to innovate so relentlessly in terms of driving costs down. It's just not going to happen. So in order for the competition to come, they need to do the impossible.
And then beyond that, they're rolling out the wide release of the FSD beta here in the fourth quarter in North America. And we think that's going to support margins as we get into next year, but it's also, I think, going to drive demand. And just the last point here is that, when you talk about this, we're talking about, a relatively strong demand environment already. They're sitting only at 8 days of inventory at the end of the quarter. And so it's really we're not seeing a demand problem. We're seeing a relative move, but it's a very small one on an absolute basis.
Yeah, especially compared to some of the other automakers, Colin. I think what you're speaking to is sort of this larger picture. Maybe you're going to see some volatility quarter to quarter, but, has that larger picture changed? This is a company, an EV maker that still offers the best value and has optionality around a number of different other businesses like storage and solar. He also talked a lot about robotics last night. But I do wonder, Colin, you haven't mentioned the Chinese automakers. What do you think about what BYD and NIO are doing? Could that be competition, not just in China, but abroad? Typically, Chinese automakers haven't had success abroad, but could that change?
Absolutely. We saw it with, the Japanese automakers historically, as well as Korean automakers, and certainly that's going to be a dynamic. What is different from the story around Japan and Korea is the geopolitical implications of buying Chinese cars in other markets. And I think certainly there's going to be a cost dynamic, but also there's going to be, a level of, protecting industry and economies as consumers look at some of these things. And I think Tesla going into China, and really competing on a cost basis there is important for them, from a supply chain perspective, but also in terms of just best practices as they bring some of those best practices out into other geographies in their factories. And I think that sort of learning is important for the company as they look at some of these other markets.
Plenty of great points here. One I really want to focus on is the concept of Chinese EV makers being legitimate competition for Tesla. No, not even close. But, and this is a big but. Hey, stop that. No dumb jokes today. Stop that. No, it's a serious video. Stop. Chinese automakers will be very competitive with legacy automotive manufacturers attempting to make EVs. Let me just spoil the whole fucking movie. If you haven't seen how the next decade plays out, you might not want to watch this because I'm about to spoil it. There's going to be an invasion of Chinese EVs into the United States and into Europe and other parts of the world. Not just Chinese, but also Korean. These companies won't be competing with Tesla nor stealing Tesla's sales or their customers instead. They'll be eating the lunch of legacy automotive manufacturers. That's how things play out. The future of the automotive industry, if you were to draw it in a pie chart, Tesla has a huge slice of the pie, Chinese EV makers have a huge slice of the pie, and everyone else is competing for the scraps.
I think that, we have a market backdrop where, any kind of miss the stock's going to hit like this. I do think that we're set for a very, very strong Q4. The stock's underowned in a lot of people's portfolio out there, especially, as an S&P 500 constituent and a very large one. And so I think there's a lot of room for people to buy it and buy it on this dip ahead of a very good quarter.
So as you'll know, unless you're a brain-dead moron who invents things that aren't true, which does happen, I never give investment advice, ever, because I'm not that dumb. You should think for yourself, and I'm not going to put myself in a position where I've been advising people to do anything other than to use their own brain, think for themselves, and act accordingly. But this guy, well, he can give investment advice, and I believe what he just said was that investors should maybe buy the dip, leading into an extremely strong Q4. I suggest his comments may age relatively well. That is, of course, if you're a long-term investor rather than a short-term gambler, aka dick chart reading astrology for stocks gambler / trader, or whatever they are. I don't know, I'm out of my depth. I'm not smart enough to understand all that technical analysis. So let's move on.
Musk has said, it's important to smooth out some of these quarters and to make it easier on workers in the factories. You think that's going to be in the offing? What's your target look like for next year?
Yeah, so we don't grow by 50% like they talk about year after year 50% growth. I do think that this is something that's plagued them, is the going direct to consumers versus dealerships. They always have this rush at the end of each quarter. They're trying to smooth that out. They've tried to do that for a while. I think ramping up the factory in Berlin, a factory in Austin will help that, as well as getting cars closer to the consumers.
How big is the opportunity around the semi truck that's expected to start getting delivered at the end of this year?
I think that the important thing is that we got a new product out there. We haven't had a new product really since the Model Y, the Cybertruck next. They alluded to a $25,000 or less expensive car out there as well. But anytime you get a new product out there, I think it's good for a product refresh. In the grander scheme of things, it's a big market, not as big as the passenger car market, but it's good that they finally get out there, after being delayed after several years.
Yeah, the other market we don't talk about very often is the energy storage business within Tesla as well. It's not a very big part of the overall revenue picture, but the fact that we have seen these spikes in energy costs, not just here, but abroad, is there growing demand here? And why isn't Tesla making, I guess, more use of that opportunity?
I thought this was one of the highlights of the quarter, and I cover renewable energy as well. And I remember a few years ago, Elon talking, hey, we're going to do 1 gigawatt next year, 2, 5, throwing out these big numbers. Well, they did a massive amount. So to put in perspective, about 5 coal plants they did during the quarter, if you put that in terms of batteries.
Now, this is a great analogy, and it's the first time I've heard an analyst actually describe Tesla's battery storage products in terms of the equivalent number of coal plants. Of course, I haven't fact-checked, but let's assume this is true. We can start to see that Tesla's energy business is actually growing and already at a reasonable scale, but things are still just getting started.
And I think that business continues to grow. Why hasn't it grown faster? I think the main reason is because their cell supply is constrained. But they're the best in that. You see all these other OEMs, auto OEMs, even GM moving into this space here.
You did it, Mary. You led about 10 years after Tesla.
They haven't had the foresight that Tesla has and across the supply chain here. And so I think Tesla's a leader there. I think they will be. And I think that business can be a very large business by itself.
Ben, it's David. A Musk conference call is different than pretty much every other CEO's out there. But that said, I'm just curious to get your reaction to his comment that he thinks there is at least a potential path for Tesla to be worth what Apple and Saudi Aramco are worth right now combined.
I think, thanks, David. I think a few years ago, I remember, he was late for a conference call. I think it was the SpaceX, had delays or something. And he comes in, the first thing he says is that, Tesla is going to be bigger than Apple. And that was when the company was $50 billion or something like that. And, everyone kind of laughed him out. So, it's a big statement there. But I go back to that and, he's not that far off. He gave himself till 2025 bigger than Apple back then. And so, I don't underestimate him. I don't like everything he says, but, At least it goes big.
There's been plenty of discussion around Elon's comments of Tesla being worth more than Apple and Saudi Aramco combined in the future, e.g. more than a $4 trillion market cap. Just putting that in context, that would mean Tesla, in terms of market cap or Tesla stock, increasing around 6 times from its current levels. Let me know in the comments below. If you saw a 6 times return on your current Tesla stock holdings, would you be happy with that? Personally, I'd be very happy with that. In fact, I think there's only one place you can get a better return on investment than Tesla stock over the next few years. And that, of course, would be by joining Patreon with the card in the corner or the link in the pinned comment. Hashtag not investment advice. Seriously though, you really are missing out. Tesla price targets, over 108 exclusive videos and counting. Surely the growing community of over 4,000 members can't be wrong. So, see you over on Patreon. Love ya.